Paul Rosenblum is a bookkeeper, not an accountant or a CPA. Although the information in this podcast comes from professionals, it's meant to give you enough knowledge about these subjects to have a meaningful dialogue with your tax preparer about bookkeeping and taxes.
Welcome to another episode of the not boring small business bookkeeping and accounting podcast. And I'll try once again to live up to that long name. I've survived the September 15th deadline, so I'm just glad to be here this week. I'm Paul Rosenblum. Last week, we talked about accounts payable, which is money that you owe vendors for products and services. Today, let's speak about accounts receivable, money that is owed to your company. Just like accounts payable, accounts receivable is an accrual account. On the payable side, there are vendor bills and payments of those bills. On the receivable side, there are customer invoices representing the services or products that you sell to your customers and payments from customers that have to be entered into your accounting system correctly. If you have a cash-only kind of company, such as a street vendor or website sales, then you wouldn't necessarily need to invoice a customer. They would all pay at the time of the purchase of a product or the services rendered. But many companies are mixed. They have customers or clients who pay at the time of the service as well as customers who like to get invoiced and then pay later. As I mentioned with the payables in the last episode, cash flow is something that you always have to think about as a business owner. If you accrue $25,000 of vendor bills due 30 days from now, then the idea is to have enough money in the bank in collected sales to pay vendors on time. So running reports on the receivable side is equally as important as running reports on the payable side. The IRS requires just one figure that represents your income or revenue on a tax return. However, in bookkeeping, you can have as many sales accounts on your chart of accounts as you would like to be more specific on how you made your revenue. However, very easily, you can have 15 or 20 income accounts, which makes your chart of accounts longer than it should be. I try to keep the chart of accounts short enough so that the profit and loss report will be just one page long, at least for my small to medium-sized clients. Most computerized accounting software solves that problem by having the bookkeeper create items of services and items of inventory that you sell to your customers. Each item, in turn, is then attached to an income account on the chart of accounts, and the items are now line items on a customer invoice that have separate reports. So if you use one income account on the chart of accounts, aka COA, it's perfectly fine. You can run reports on the items that you created when you first started selling products and services. It's important to business owners to know how they made their revenue, but pretty unimportant to the IRS. But I digress to another episode yet to be recorded. Similar to the accounts payable reports, the accounts receivable reports are separated into columns. The default columns represent the current invoices, meaning not yet overdue for customers to pay, 1 to 30 days overdue, 31 to 60 days overdue, and 61 to 90 days overdue. These columns are customizable in almost every accounting software out there. It's important to keep a very good eye on that, because if a customer gets to the point where they're 90 days overdue on paying an invoice, it generally gets harder and harder to collect on that debt from a customer. As your company grows, you could hire someone whose primary job is to keep track of the payables and the receivables. It could be a part-time position or a full-time position, depending on how large a company you have. Earning money is just half of a healthy business. Collecting money owed to you is the other half. In some industries, it could be customary to have people pay deposits on work that isn't started yet, almost like a retainer that lawyers take in before they do any work on your case. Then, as they work, the bookkeeper accounts for the retainer money and converts it into a revenue account when earned. So the bookkeeping is much more detailed-oriented because upfront deposits or retainers, which are booked as liabilities, have to be moved to a revenue account after they are earned and no longer refundable, hence the liability account. But again, I digress. However, if you aren't in that kind of business, the customary thing to do in many cases is to make the sale, invoice the customer, and receive payment at another time. This is what accounts receivables are. One has to look at the monthly expenses that the company has and the amount of money that the company has in monthly sales. The sales should be higher than the expenses. That's the idea anyway for a profit-making business model. So as mentioned, sometimes the expenses end up being reasonable, but the income just needs to increase in order to pay the bills and get some profit. Accounts receivable will show the income earned but not yet collected. In accrual accounting, the profit and loss report run in accrual mode will show collected and uncollected accounts receivable, as well as cash sales going directly into the bank, all showing up in your sales or revenue accounts. As the business grows, the owner or owners don't really get involved with the payables and the receivables very much, although they might still approve some bills as, quote, okay to pay, unquote, or tell the staff not to make any more deliveries to a certain customer until they pay their overdue invoices. Even if your taxes are cash-based and not accrual-based, and the accounts receivable and accounts payable aren't reported on the tax return, they are equally important if you are entering bills and customer invoices within your accounting system, even if you are running cash-based reports for tax purposes. You can also change the terms on the receivable side. You don't have to have a standard net 30 on every customer that you sell to. For some customers, you can have a due on receipt, or a net 10 due in 10 days, for an example, or 50% down payment before you do any work, and the second 50% due at the completion of the job. You can also have phases on a job. If the job is going to take you 3 months to complete, then you can either have one invoice explaining that phase 1 is due on receipt, phase 2 is due in 30 days, and phase 3 is due in 45 days or at the completion of the job. And as payments come in, they would be partial payments on that large invoice, or have 3 or 4 separate customer invoices. Receiving payments by credit card could be a plus as well. People will generally pay faster using a credit card if they don't have enough money in cash flow or money in the bank to pay the full amount. However, you have to figure in the merchant costs, anywhere between 1 and about 3.5% that you are charged by the credit card company to accept that payment from a customer. But again, sometimes it just comes down to earning more money than your company spent. From an accounting viewpoint, if your company is on a cash basis, when you run cash-based reports for the accountant or tax preparer at the end of the year or beginning of the next year, you should not see accounts payable or accounts receivable on that cash-based balance sheet. If you do, the bookkeeper needs to fix that, or at the very least explain to the accountant or the tax preparer as to why it's there. two client examples about that. Number one, I had a client who was doing her own bookkeeping and working with a, quote, bookkeeper, and I use that term loosely, who was entering invoices for sales, but accepting the downloaded payment from the bank directly to income rather than applying that payment to the unpaid invoice. This left the accounts receivable invoice open and unpaid, so the accounts receivable report is now wrong, but also added revenue to the profit and loss. The same company had situations where an invoice was made for $469 for one example, but the customer paid $500 just to round it off. That customer then had a negative balance on the accounts receivable ledger. If you have a situation like this, then the overpayment of a customer invoice can either be applied to the next invoice for that particular customer, or if there will be no more invoices for that particular customer, counted as revenue for that year by the tax preparer. The problem sometimes is that accountants at tax time putting together a tax return for a cash-based company don't even look at the accounts receivable, hence don't even look at the balance sheet all that often, so they don't know about the overpayments and other situations in accounts receivable, since accounts receivable is not a profit and loss account, it's a balance sheet account. With this client, when I started working on the books, we found about $35,000 of income recorded as accounts receivable with no invoices ever created, and had to count that negative $35,000 in accounts receivable as revenue for the current tax return. The second example happened several years ago when I saw about a negative $120,000 in accounts receivable with a cash-based company. I had to go through line by line in accounts receivable for the entire year starting on January 1 and going all the way through December 31, and a corresponding account called undeposited funds to figure out where the discrepancy was. It ended up that an invoice was dated sometime in January of the next year, but the payment was actually received against that invoice in December. Many accounting systems let you create an invoice later than the actual payment comes in. But if you're running reports at the end of the year as of 12/31, in this case, the invoice was not showing up as of 12/31, but the payment was. It was skewing the accounts receivable for the previous year by creating a negative number on the receivables, which will show up in a cash-based balance sheet report. By the way, I'm currently working on a YouTube channel to launch soon where I will post some screen shares and specific examples in accounting so that you can see what I'm talking about and not just hear it here. Since it's almost time for me to invoice my clients for the month, I'm getting back to my own receivables now and dotting my I's and crossing my T's before I email all client invoices so I can pay my producer and all of my bills. Accounts payable and accounts receivable are the backbone of most businesses, even if on a cash-based tax return. It's all about money in, money out. In other words, cash flow. Happy payables and receivables all. But right now, I'm feeling the pressure of the October 15th IRS deadline, so I'm going to run and get back to work. I'm still Paul Rosenblum, I think.